The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to bring someone back to the Rebel Capitalist Show. He's my good buddy and bond expert, Jim Bianco. Boy, oh boy, Jim. First of all, welcome back to the show. But man, this is an incredible day to be looking at macroeconomics, isn't it?
Yeah, it really is. You know, we've got a lot of cross currents in the markets. We've got the inflation story, which isn't going away. We've got geopolitics, which might be going away, and that might be a problem for some like me, and a whole lot of other things going on.
Why don't you just kind of, because this interview might come out in the next couple of days. So just for the audience, we're recording this Thursday, and this is this morning or late last night, Putin invaded Ukraine. So if you could go over a quick summary of what has happened just in the last 8 hours or so, and kind of your take.
Yeah, so Putin invaded Ukraine. And at the rate he's going right now, that before the end of the day we're recording, which is the first day, Kiev will probably fall. And within a few days, he will have this over with, at least militarily. The markets were down a lot on the idea that there was going to be consequences for Putin to take over Ukraine, meaning that we were going to have hard sanctions. So the NASDAQ was down as much as 3%. Oil, WTI oil was up over $100 a barrel. And then about 1:30 Eastern time, President Biden came out and he laid out the sanctions that they're proposing. And Russian stocks went straight up. The S&P went green on the day. And we went from $100 on WTI oil to $92 on WTI oil, and actually finished down on the day. So we completely reversed a lot of this because the markets were worried that that we were going to sanction Russia, which meant there was going to be a restriction of commodity flows out of Russia: oil, aluminum, gold, nickel, everything else they produce. And you could throw in the Ukraine too, which is a big wheat exporter. And we were afraid we were going to have sanctions that were going to restrict that. At the end of the day, we've got sanctions that are going to do pretty much none of that. And in fact, Biden himself said that these sanctions won't last forever. So they made a big noise about trying to punish the Russians for taking over the Ukraine. But the initial response right now is they're not going to really punish them to any great degree. So Putin got the Ukraine, and he sets his sights on whatever he's got next in mind.
Why do you think that these sanctions, or the sanctions they threw at them, don't have any teeth? Is it because Russia has an extreme amount of leverage, and if they sanction Russia, effectively, they're also sanctioning their trade partners from getting goods and materials from Russia that they could desperately need?
So can I answer the question this way? Russia's got a lot of leverage on the West because the West doesn't want to take any pain. If you want to sanction the Russians, that means deny them the ability to trade with us, which means deny us something.
Right.
But we don't want to deny us something. So when President Biden first started speaking and he said these sanctions are designed to minimize the pain on the American public, that means that they're not going to be effective. If you want to make it effective, you have to deny Russia money. And you have to deny Russia money by not buying stuff from them. But then that means the price of oil might go up a lot. And he mentioned it 3 or 4 times about his extreme concern about gas prices. So you can reconstitute the old Soviet Union and you can spread tyranny through the area as long as the price at the pump doesn't go up. But, and that seems to be the trade-off we want to make. Now, ultimately, I think that will be a disastrous trade-off in the long run. But the short run seems to be all that anybody's interested in. They just don't want the price of oil to go up next week.
I wonder if that's what Putin was thinking as far as his timing here, because he looks at the United States. He sees how unpopular Joe Biden is in the polls, and he knows that's because of inflation. And then he looks at what's happening with the nat gas prices throughout Europe, specifically in Germany, and he knows that they can't tolerate higher gas prices there. And if the politicians want to get reelected, they're going to have to lower those prices. And if they go up, the probability of them being reelected is lower and lower and lower. And Putin is just using that against the politicians in Europe and here in the United States. It seems like that could be his angle.
Oh, of course, that's his angle. That's exactly his angle. And if you look at his history, look at the history between them and China. So in 2008, and you'll see a pattern here, in 2008, during the Beijing Olympics, right hours before the opening ceremony, he attacked Georgia. That was the middle of the financial crisis. That was the middle of a recession, and the world was being distracted by the Olympics. 2014, right after the Sochi Winter Olympics, he took over Crimea. 2020, the day after the Beijing Winter Olympics ended, he attacks the Ukraine. So this is a pattern that we've seen. I think he really likes Olympics. He thinks it's a prelude to war, because he's 3 for 3 with that right now too. And that's not it. We could also throw in 2020, China takes over Hong Kong, and the rest of the world collectively did nothing about it. And if you want to even throw in 2021, we gave Afghanistan back to the Taliban. So there has been plenty of examples that when the West doesn't have the stomach to be the world cop, the West doesn't have the stomach to impose any kind of sanctions. Okay, if you want to argue we shouldn't be the world cop, that's fine. That's a good argument to have. But then we can't also then start to complain that Putin wants to reconstitute the old Soviet Union, and now Xi has got to be staring right at Taiwan.
That's my next question. Yeah.
Yes. In fact, last night, Xi gave a speech, and he basically said that Taiwan is nothing like the Ukraine. And what he meant was the Ukraine is a sovereign country that Russia feels it has a right to invade. Taiwan isn't even a sovereign country in his mind. It is part of China. It would be like sending the National Guard to Washington, D.C. In his mind, that's what it would be if they were to send troops into Taiwan. It's not even a sovereign country, so according to them. So he's already said that, them sending troops into Taiwan is actually less of a problem than Putin sending troops into the Ukraine. And again, all the way through the line for the last 13 years, this has happened over and over again. No one stops anybody from doing this. Again, you want to argue that we shouldn't, that's fine, but then don't complain when you can't get any more when you can't get any more semiconductors. 60% of semiconductor production is in Taiwan right now, Taiwan Semi. And if they take over Taiwan and take over Taiwan Semi, they are going to have a monopoly hold on the production of semiconductors, which we already have a problem on. If you don't complain about high grain prices or energy prices, when the Soviet Union, or excuse me, I'm getting ahead of myself. That's what he's trying to create. When Russia and the Ukraine are going to start to, have restrictions on their exports as well too.
How do you think that's where we go next with China going into Taiwan?
Why not? What are we going to do about it if they do? Seriously, given this track record, if they marched into Taiwan tomorrow, other than sending strong letters to the UN, and we know that's really effective, what else are we going to do? We're not going to do anything about it.
Yeah, it almost makes it seem as though this could have been planned between Putin and Xi Jinping behind the scenes, that, hey, you do this at this moment, I'll do it right after. And we're going to spread them so thin, and we've got so much leverage, and we're going to catch them off guard that there's really nothing that they can do. I mean, I don't have any proof of that, but it wouldn't surprise me.
Well, some people have argued that, there was Putin attended the opening ceremonies 3 weeks ago. He had a big long meeting with Xi, big handshake, slapping each other on the back. And of course, there was no Western diplomats there because we were boycotting it. So, could that have been a deal? Sure. They just were together face to face 3 weeks ago. And the day after the Olympics ended is the day that they moved in to Eastern Ukraine.
So using some game theory, how do you think this plays out over the next couple weeks or the next couple months? I mean, do we just continue to threaten them with words or just kind of idle sanctions, and they just shrug it off and continue to try to take over whatever territory they want to take over? And how many territories, how far do you think they want to go?
Oh, I think that, I think they want to go the whole 9 yards and reconstitute the old Soviet Union. So Kazakhstan will be on the list. The Baltic states, Latvia, Estonia, Lithuania will be on the list as well too. And I don't think that, now they're not on the list next week or maybe even next year, but that's ultimately what his goal is. Look, it's been pointed out that the Soviet Union, there I go again, Russia's GDP is about the size of Florida, about $1.3 trillion. In other words, they're not a very important economic power, but they want to be important on the world stage. So they want to reconstitute the Soviet empire. They want to give themselves purpose and meaning in terms of having that kind of projection around the world. And that seems to be what the Russian people want, seems to be certainly what Putin wants. And this process will continue along the way. And I think she's got the same designs for Asia as well, too. So we'll see whether or not Taiwan can remain an independent country at this point and how long they can remain an independent country. But we've got no example of anything in the last 13 years that would suggest that if he crosses that line and goes into Taiwan, that we would do anything other than a bunch of words, but not really a whole lot of meaning.
So just as a quick story, I've got a very good friend that's Russian. It's in St. Petersburg right now. And I texted them last night and I said, what is, not your opinion, but just help me understand kind of the general rationale or the general argument for Russia invading Ukraine. And basically they responded to me. And the thrust was, well, back in 1990, we gave Ukraine a tremendous amount of weapons. And we said, hey, we're giving you these weapons, but don't join NATO. And they went ahead and joined NATO. And then they pointed those weapons at St. Petersburg and Moscow, just like if there were weapons in Mexico or Canada pointed at the United States. And Putin is simply going in and doing something to make sure that there's a buffer zone between the weapons and the Russian border or those important cities. That's it. And I'm not saying that's right or wrong. People got crazy when I tweeted that out. It was just kind of an FYI. This is
Right.
kind of the general argument over there. And I think that regardless of whether it's propaganda or not, that we should be, as astute investors, we should be paying attention to how they're viewing this. So do you have any thoughts on that?
Yeah, first of all, the first big thought I have is that Ukraine is not part of NATO. There's been talk of them possibly joining NATO, but they never did. And it looked like they never would. And the second thing is, the Ukraine had, after the Soviet Union fell, a bunch of nuclear weapons. In 1994, they cut a deal with the US, the UK, and Russia, that in agreement for giving up all of their nuclear weapons, they got a security agreement that none of those three countries would ever invade the Ukraine. And if it was invaded, that they would come to their rescue. Well, Russia violated that agreement by invading them. And we seem to be violating that agreement by not coming to their rescue. And they left themselves vulnerable 26 years ago by giving up all of those nuclear weapons. Those were old Soviet nuclear weapons they had after the Soviet Union disintegrated and what was left in Ukraine territory. So again, if you are an ally of the United States anywhere in the world, it seems like the very clear message is you're on your own. Good luck, because we're not going to come and help anybody under any agreement or for any reason right now. About the only thing you can do today in the world to get yourself in serious trouble is drive a truck up to Ottawa and honk your horn too much. That's the only thing that will get you in trouble right now.
Great point, my friend. Great point. I know someone on Twitter that is one of my trolls. I'm sure you have many of them as well. And I was posting something, about Russia, or maybe that text I got from my good friend, and they posted a video of the Russian police like beating down a protester there. It was a horrible video, obviously something that you never want to see in any country and under any
I
circumstances.
think you mean the Canadian police, but you were right about calling them the Russian police.
No, it was the Russian police.
Oh, what's the Russian police? Okay,
that's
I'm sorry.
how I responded. I said, "Is this a video of Canada?"
Yeah.
So anyway,
Right. I mean, in the last 2 weeks, the most egregious thing that's happened in the world has been a bunch of truckers honking their horns too much. That is because we took their bank accounts away from them.
Yeah.
We did not take Putin's bank account away from him. That would have been locking him out of the SWIFT network. We elected to not do that. And Biden at least was very clear about that in his press conference. He said the reason we didn't go SWIFT or push them off of SWIFT was that the Europeans didn't want to do that.
For obvious reasons, because the Europeans are screwed if Russia gets kicked off of SWIFT, because then they, correct me if I'm wrong, but they don't get any natural gas then. And
right.
What happens to prices for electricity if that happens?
Right. Just so everybody knows, the SWIFT is the international payment system. If you deny a country from being in SWIFT, and we did with Iran in 1980, to give one example, you've effectively done what you've done to the Canadian truckers. You've taken away their bank account. So if you take them off of SWIFT, the next day, there's no way to do a transaction with them. There's no way to pay them for that transaction. And as it was pointed out by Javier Blas at Bloomberg, today we had agreements to buy $350 million, we being the West, not just the United States, the West in total, $350 million worth of oil and $350 million worth of other commodities, tin, aluminum, copper, et cetera, from Russia today. And we did that transaction today. If you kick them off of SWIFT, you can no longer do those transactions. Now, the Russians have other avenues. They could go through their friends like Iran or China. They could sell their oil to China. They could sell their oil to Iran as well, too. So they wouldn't be 100% shut out, but that would hurt. But of course, the problem is it would hurt Europe. It would hurt Europe a lot.
So Russia wouldn't be completely cut off, but the trading partners to Russia would definitely be 100% cut off. And that's the leverage there potentially in Russia's favor.
Right. And to keep in mind, really what's going on here is why Putin has so much leverage. He doesn't care if he gets cut off. He doesn't care that his stock market, the Russian stock market, was down 38% yesterday, 38% in one day. It's down over 51% in 6 trading days. He doesn't care. In the US, when that's S&P is down 11%, we've got people on their knees praying for a rebound. And so that's the difference between the two.
I think you just hit on a huge point that very few Americans understand because they don't travel internationally. In fact, I had my sister last night late text me and said that they froze they stopped the trading on the Russian stock exchange. And I said, okay, that's a big deal. But what you've got to understand is I'm in Colombia right now, in Medellin. And I told her if they closed the Colombian stock exchange, that wouldn't even make the front of the newspaper. That would be a nothing burger. No one would care because no one here is invested in stocks, or very, very, very few people. It doesn't equal the entirety of the purchasing power for society at large, like it does to a certain degree in the United States. So Americans don't understand that. They just, and again, that gives, and then Putin doesn't have to get reelected, which is another reason why he can just say, forget your SWIFT system.
Right. And so that's the leverage over us that everybody has, is that if you want to scare the shit out of Americans, threaten to drive their stock market down, or threaten to drive the price of gas up. Right. And it is such a big threat that while President Biden had given us bellicose language about what had happened. He can't do anything about it, because if you do, you wind up, hurting the other half of their trading partner, which is the West, which is us. So they've got all of the leverage. And to your point, not everybody thinks hedonistically like we do in the US. All we want to do is make more money. All we want to do is have bigger and nicer things. Look, I'm as guilty of that as everybody else. So I'm not trying to morally stand over anybody else, but I also recognize that that's what we are. In Russia, he gives speeches about how we are going to reconstitute our empire and we are going to be relevant again. And if it creates, and this is the struggle that we have to do as we go through the Ukraine and everything else, and everybody's all for it. And if their stock market or economy takes a hit, so what? That's their attitude. They want a sense of purpose and meaning as they recreate their empire and be relevant again. That is a very difficult concept to get across in the West to everybody else, that there's some more meaning than just making another buck is what in the rest of the world.
Yeah, that makes a lot of sense. So talking about being backed up into a corner, what does the Fed do?
Well, the Fed has got a big problem on its hands that what's happened in the Ukraine and everything almost supersedes it. It's more important. And that is inflation. We have real, honest inflation in this country, and it's no longer transitory. And the Fed has been so far behind the curve in recognizing that we have real inflation that they're still easing. They're still buying bonds through March 9th. So they're still easing right now. The perception has been that the Fed will start a rate hike campaign in March. And we've quibbled a little bit about whether or not they'll go 50 basis points or 25. And the market's kind of settling in that they're going to go 25. And I think that the Fed is going to have to continue on that idea. And they're going to have to continue on this rate hike campaign. And that they're going to do several rate hikes, probably the first 4 or 5 meetings. There'll be at least one rate hike in every one of those meetings. There's a possibility there might be a 50 basis point rate hike in there somewhere along the way. Now, why do they
do that even if this this invasion with Russia and Ukraine, and even what we're talking about with China, even if that escalates and the market goes down, let's say even another 15 or 20%, you still think they follow through with those rate hikes?
Well, yeah. So let me parse some of those words. Escalate. What escalate, I think, means is if financial markets go down, not if the fighting drags out. Like I said, the fighting could be done within a couple of days. It's going to be, the Ukraine military is no match for the Russian military. So the fighting part of this will be over very soon. And then really what we're talking about is if the markets go down. So let me back up. If you have high inflation, what is the one thing a central bank could do to bring the inflation rate down? Hit demand, lower demand, hurt the economy in order to lower demand, to lower the need to bid prices, and prices come down. If the markets want to do it for you by tanking another 15 or 20%, yes, you'll do less rate hikes. But if the markets don't want to do it for you, and we're up over 0.5% on the day after being down a lot in the morning, as we talk here on Thursday, then the central bank is going to have to do it. But either way, you're going to have to get a hit to demand. The option that everybody wants is the Fed to stop raising rates, the S&P to go to 5,000 and inflation to magically disappear. Now that ain't going to happen. Yeah, I do too. And I want candy and cotton candy and gumballs to fall from the sky as well. So all the Fed has is trade-offs right now. And one of the trade-offs that they've struggled with, and this is what when we talk about the Fed, let me back up and say, they've got to decide what their priority is right now. Is their priority growth? And growth has many forms to it. Lower unemployment. The Fed put calls under growth because reverse wealth effects and wealth effects as well. Is policy prioritized towards growth, or is it prioritized towards inflation? Now, from 2008, when Bernanke started modern QE, to the spring of last year, when we got the last stimmy check for $1,400, the Fed's priority was growth. Every time anything wobbled, turn on the printing press, make the wobble go away. And as long as you didn't have inflation, everybody was a genius over in the Eccles building at the Fed. But now that you have inflation, there's a question about the Fed's priority right now. And I think their priority is shifting to inflation. Why? Poll after poll is showing two things. I'm talking about political polls. One, the president's approval rating and Congress's approval rating are tanking. In fact, Biden's approval rating on this is day 400-ish of his presidency is lower now than day 400-ish of Trump's presidency. And everybody thought that Trump was the lowest rated president ever, which he was. And now Biden's below him. So Biden's setting new record lows for the day in your presidency approval rating as well. And Congress's approval rating is tanking. Poll after poll asks people, what is the number one issue in the country? Right. Number one, right. Inflation. It is not climate. It is not crime. It is not COVID. It is not immigration. It is not any of those other issues, foreign affairs, Ukraine. It is inflation. And the public, and I'm not insulting the public, they don't know much about the Fed, but they don't need to. That's not their responsibility to know much about the Fed. They just know they're paying more for prices and they're taking it out on elected politicians. In the polls, at least right now. And elected politicians are putting enormous pressure on the Fed. Biden has already given more than one speech where he said, I know inflation's a problem, and here's what we're going to do about it. There's this guy named Jay Powell, he works at the Federal Reserve, and they're going to fix it for you. He says that's essentially what he said on more than one occasion. So the Fed has to deal with inflation. One other thing to think about inflation. The Fed does a survey every 3 years of consumer finances. And the last one was 2019. They're going to do another one this summer. 40% of the American public has less than $1,000 of savings. This was as of 2019. There's no reason to think it's materially different.
Right.
Has less than $1,000 of savings and rents. Those people are crushed. Every single one of them are crushed with higher prices because of inflation. They go to the store, the pump, the grocery store, the supermarket, and they get less for the same amount of money almost every month. The other half of the people, the top 10%, me, you, okay, I get equally crushed. You get equally crushed at the store because of inflation, but I own my house. I have an investment portfolio. I have other assets. They're going up faster than the inflation rate. The S&P was up 29% last year. According to Case-Shiller, the average home price increased 18% in 2021, at least through November. That's the latest data we have for Case-Shiller right now. And so, yeah, okay, I see it too at the store. And I see it at the store. But then I look at the price of my house, I look at my investment portfolio, and I go, man, I did a terrible job with my stock market, with my stock picks, because they were only up 25% when the stock market was up 29%. And I say, okay, inflation, I'm better off since the inflation thing started because my assets have gone up. So now the Fed's got a choice. You're going to protect growth or you're going to protect inflation? The 40% that are screaming at politicians or the 10% that own stocks? And I think they're going to pivot towards the 40%. The last thing to keep in mind, a lot of people don't remember this about the late 70s, but inflation was awful. I've heard people on Twitter and everything else go, well, do you know what's going to happen to this country if we had a 30% correction in stocks? And I was like, it's worse if we have 10% inflation. That's worse. That is flat out worse. Because in the late 70s, we had blockades of Washington. We had farmers basically blockade the Federal Reserve building. Volcker couldn't go to work. Sound like Ottawa a little bit. We had builders mail 2x4s, thousands of them to the Fed. I don't need them because you're killing me with this high inflation and high interest rates. We had a crazy guy with a gun break into the Fed in December of 81 and wanted to take the FOMC hostage make them lower interest rates and put them on trial for treason. I am not making that up. A guy with a gun broke into the Fed in December 81. That's how irate people get about inflation. And we forgot, oh my God, if the stock market goes down 20%, that's child's play compared to double-digit inflation. And we're already at 7.5, and we're pushing $100 on oil, and we're probably going to see some restrictions coming because of the Ukraine, that the flow of goods is going to be restricted somewhat, which probably means higher prices.
That's a great point about inflation in the stock market. I was going to try to ask you about aggregate demand, because let's go to the early 1970s. From 72 to 74, the stock market went down in nominal terms by 50%, but we still had significant consumer price inflation. So, but now it seems though it's a little bit different from the standpoint of the purchasing power. Aggregate demand is so dependent, or so much more dependent, on the stock market, that if you had that decline in the stock prices, you might not have to actually have positive real rates to bring down the rate of CPI. What are your thoughts on that?
Oh, I think you're exactly right. If you look at market cap to GDP as one metric, that in the early 70s, that metric was about 50%. So that means that the stock market's gross market value was half the level of production of the economy, half the level of GDP.
Right.
Today, it's over 200%. It's twice the level of GDP. That's why you get this enormous wealth effect that comes from rising and falling asset prices. Well, mostly for the last 13 years or so since the financial crisis, asset prices have been rising, and rising quite a bit, at least through the end of this year. And the result of that has been, we all know what the result of that has been. We call it inequality. You know, that rich people just sit there and watch their asset prices go up. Poor people, those 40% with the $1,000 savings, they don't have investment portfolios. They don't benefit from that as well, too. So you've seen this inequality gap grow and grow along the way. And so I think that you're right. In the early 70s, you could have these giant fluctuations in the stock market because it didn't produce as much of a wealth effect as we see right now in the market. And because of that, the Fed wasn't as attuned to growth or worried about financial stability like they are today.
Goes back to Russia.
Yeah, it goes back.
Russian stock market, it really, or most likely, doesn't have that much bearing on aggregate demand or purchasing power, just like the U.S. in the 1970s.
You know, let me put it to you, when you say it goes back to Russia, let me put it to you this way. Could you imagine if it was the mid 1970s and you turned to the president, whether it was Nixon or Ford or Carter, and said that, you know, somebody misbehaved, let's call it this country named Vietnam. And you got two choices. You can either send hundreds of thousands of troops to commit tens of thousands of young men to death fighting a war in a jungle in Vietnam, or you could direct your Treasury Secretary to push a bunch of buttons and cut them off of a SWIFT system and put a bunch of economic sanctions on them that could really, really hurt and maybe have the same effect without sending troops. You don't think that they would have done that in a heartbeat? And you've got that option right now. You don't have to send troops to Russia, but you could, if you wanted to be forceful, inflict almost as much pain on them as if you had troops. But we might feel the brunt of that. Right. But so that all of a sudden that becomes intolerable, you know, and so that's where I think everything is kind of, you know, it's a missed opportunity. We're at a point in 2022 where if we want to engage with a bad actor, we could do it without sending troops, but then we might have to feel the brunt of that. But we don't have to send thousands of young men to put them in harm's way. But instead, we say, oh no, but see, that might mean that we might have a bad week in the S&P. So we can't really do that. And so we just bluster that we're going to, you know, try and, you know, say that we're concerned about this stuff, but not really do anything. And the problem is bad actors know that, and they know that we're kind of toothless.
Yeah, we're now held hostage by the asset bubbles that we have created and become dependent on.
Right. And, you know, is there any downside to having an asset bubble other than the asset bubble popping? Well, that's obviously a downside. Well, other actors know that we're beholden to these asset bubbles and they'll take advantage of it. And that's exactly what they've been doing.
Let's move to the yield curve. I mean, that's something that's applicable to the conversation, but
Yep, absolutely.
I've really been paying attention to the twos and the tens, as I'm sure you have. And what I found fascinating, I just did a bit of research a couple weeks ago, going back to 1950, I think it was. Most people know that every single time we've had an inversion of the curve, we've had a recession. But what I didn't realize is we've never had a recession without an inversion in the curve. And so, what I've been trying to think through as the curve is flattening, if the Fed raises rates, what's the probability that we get an inversion, meaning the 2-year goes up at, let's say, a faster rate than the 10-year? And then if it does invert, we get a recession, not 100%, but probability is extremely high if you look at history. And then what does that do to the stock market? What does that do to asset? What does that do to unemployment? What happens if we go from a labor shortage to a labor surplus? And then what does that mean for the CPI? I did a whiteboard video the other day that I got a lot of heat from, but it's good.
That means it was good.
Yeah, because it brought up a thought experiment where I said that I think there's a good probability that CPI could go down in Q3, Q4. Now, that doesn't mean that we have deflation. It doesn't mean that we don't still have high rates of inflation, but it just takes a breather, and then it depends on what the government does from there. How much deficit spending do we get? What does the Fed do to incentivize psychologically, let's just say, the market to go higher, people to take risk? There are all of these things that we need to consider. But if you're looking at what the curve is doing, there's, I think, a good argument for inflation going down, but not going down to a low level, still a high level, but going down from wherever it may be in Q2 or Q3. How do you see that? I know you're an expert on these things like bonds and the yield curve.
So first of all, yes, you're correct that the yield curve has had an extraordinary track record of predicting or foreseeing inflation, recessions, excuse me. It's 8 for 8 in all the recessions back to the late 1960s. So we've had 8 recessions since 1969, and the yield curve is inverted before all of them. And to be clear, and also it inverted, uninverted, and inverted with the double dip recessions in the early 1980s. So it got each one of those individually correct. Now, why does that work? It's if it is a freely traded instrument and it is a measure of long-term rates versus short-term rates. When short-term rates rise above long-term rates, it is a sign that there is a lot of stress in the financial system, especially the banking system early on. And it is a sign that lending, whether it be corporate bonds or bank loans, are going to come under pressure. And it is a warning sign that the economy, or as we like to say in the markets, it's a warning sign something's going to break.
Right.
Typically, when the yield curve inverts, one of 3 things happens soon after, and maybe all 3 are a combination of them. You have a severe economic slowdown into a recession, you have a big fall in financial markets, or you have something break, plumbing of the financial system, a financial crisis, like in 1990. Yeah, repo in 2019 would be an example of something breaking. The repo market broke. Another example of that would be the yield curve did briefly invert in 1998, and you wound up having the long-term capital blow up. It was part of the Asian financial crisis was underway. Then you had the Russian debt moratorium of late 1998. The financial markets became very unhinged at a while. So whenever the yield curve inverts, I like to say it's a signal that something is either broken or is about to break. Either the plumbing, the markets are going to plunge, or the economy is going to slow down, or, like I said, a combination thereof. It may not be apparent the day that the yield curve inverts what is broken, or it might not have even quite broken yet, but it's coming. And especially if the yield curve is persistently inverted. There's a difference if the yield curve inverts for 2 days, goes to -1 basis point for a couple of days, and then steepens back out, as opposed to it goes negative and stays there for 2 months. If it goes negative and stays there for 2 months, then there's a warning sign that something's going to happen. And it's either that breakage of something or the plunge in the financial markets or the slowdown. All of those accumulate together, and it's then give you anywhere between 6 months and 2 years later an actual recession.
Yeah. So what I've tried to think through is if the Fed raises rates, let's say 7 times,
Right.
so that takes us up to what, 175 basis point between 150 and 175 on Fed funds.
Right.
And just assuming that you've kind of got that normal delta between Fed funds and the 2-year at, say, whatever, 60 basis points, let's call it.
Right.
So now your 2 years at 2.3, 2.4, something like that. And then the 10-year right now, as we speak, is right around, I think, 1.9, 1.2.
Yeah,
So,
1.97 to be exact. This is where the 10-year is right now.
So I just think that if the Fed raises that high, I think there's a very good probability that you get that inversion, because I see, that would mean that the 10-year would have to go up by, whatever, call it 50, 60 basis points. And, we're seeing the 10-year go up, but as of the last month or so, we're seeing the 2-year go up at a much faster rate. So I guess my question is, what do you think the probabilities are that we actually get that inversion if the Fed raises 7 times?
Oh, I think it's almost a certainty if
Okay.
they raise it 7 times. And the reason is that every inversion, the yield curve inverts almost the same way. Short rates go up with the Fed raising rates.
Yeah, right. Yeah.
And long rates actually trend sideways to down. So if you ask me at the end of the year, if the funds rate's at 175, you said the delta's 60 basis points, call it 230. Actually, when the Fed's raising rates, the delta's more like 100. But let's just stick with 230. Where would the 10-year be at the end of the year? It'd be 1.5 is where it would be at the end of the year. It would probably trend down. Now, why would the 10-year trend down? Because that would be the market signal. Something's not right here. Something's not right here. Something's going to break. And where do I want to hide when something breaks? Long-term treasuries. Don't want to hide in 2-year notes because the Fed's raising rates. Want to hide in long-term treasuries. They catch a bid. They actually catch a bid right as the yield curve inverts.
Why would people want to hide there if CPI is at 7.5? I think that's something that most people struggle with.
Right. Well, that is true because we haven't had that situation with the negative rates, with negative real rates. The answer I would give you is the perception. Remember, what kills inflation? And what kills inflation very quickly is demand. And so I think people would hide in the 10-year at 1.5% because they would be believing that the inflation rate is going to be coming down rapidly. Now it's going to be coming down rapidly. And I want to delineate what I'm saying here, because a lot of people are saying the inflation rate is going to come down rapidly, but they're arguing within an environment of positive growth and higher markets. I'm saying, no, it will come down rapidly if you have damaged the economy through rate hikes. Remember, one of the problems with the Fed is when they start rate hike campaigns, say once they go past 3 rate hikes, another thing you find that's very rare is go back and look at 3 rate hikes in a row. That's in Gould's old 3 Steps and a Stumble for those old technicians that remember him. When do those rate hike campaigns end? Almost every single one of them end with the yield curve inverting, something breaking, in a recession. And why is that? Because when the Fed starts raising rates, they know why they're raising rates. They don't know when to stop. They don't know when they've reached their objective. So they keep going and going and going. And then something breaks, repo market in 2019. Okay, I guess now we can stop. But it's too late. You've already done the damage. And now we're just going to wait for the fallout to occur. So I think what the bond market would be recognizing with 1.5 is that, all right, you've broken things and you're going to break demand, and that's going to come down. That's going to bring down the inflation rate quite a bit. And that's why I'm not afraid to hide in a 1.5% bond. One other thing, George, what I'm also suggesting here is we're never going to get rates over 2, and we're going to break something. by getting rates all the way to 2. Why isn't that we have to get rates to 5 or 6 or something like that to break something? Well, for the last 30 years, every time the Fed raises rates, it seems like they stop at a lower level. It was 6% in 94. It was 5.5%. It was 2 3/8 in 2019. And at every point when they stop, something's broken and the yield curve is inverted. Now, why is that? Because the economy can't handle higher rates. So at $30 trillion of debt with huge deficits and tremendous leverage in the economy, all you need is a 2% rate, and that could put the economy down in one knee. If the debt to GDP ratio was half of what it is today, it's 120% today, an all-time high, was 60% like it was 30 years ago, maybe you can go all the way to 6% rates before that happened. You can't, you're never going to make it, So whenever I hear these economists to say that, oh no, the Fed, Bill Dudley, former New York Fed president, saying the Fed might have to raise rates to 4% or higher. Like, yeah, that it would, to be able to even get interest rates to 4%, to get there without everything just being busted all over the floor would be an accomplishment. I don't think we could ever get rates that high, because long before we get to 4%, like with a 2 handle, you'll have the yield curve inverted and you'll have a mess on your hands long before that. So some people are right. We can't handle higher rates. You're right. And that's why it will only take 2%, I think, to invert the curve, and not 4% or not 5%.
Yeah, but I think that's an argument that a lot of people use as to why inflation will go from 7.5 to 9 to 14 to 25 to 40 to 100 and just never stop. Number one, people think in terms of just a linear process, which is, right. If you look at inflation, that's not how it works. It goes up, down. It's very volatile. But they would argue that unless the Fed can get positive real rates, that inflation will continue to go up, because that's the only way to stop inflation once it's started. Do you agree? Do you disagree? If you disagree, what's the flaw in that argument?
No, I agree that people say that argument, that we need to get to positive real rates. And the assumption that they're making in that argument is that there's going to be the act of raising rates is not going to have any kind of impact. That the inflation rate is going to stay at 7.
Clear on CPI, right?
Yeah, on CPI, the inflation rate's 7.5%. Well, what happens when the Fed raises rates 7 times and the inflation rate's still 7.5%? No, it actually might be 3 at that point on its way down. But what I want to emphasize is most economists that tell you that the inflation rate will peak and come down, most mainstream economists think that will occur as a byproduct of a strong growth, soaring stock market environment, that the inflation rate will come down. I'm saying that raising rates, you will smash inflation because you've damaged the economy. And that's what will bring the inflation rate down. So yeah, you'll get your positive real rates, but you might get them with a 2 handle on it all over again. And then there's be no doubt that the Fed will say, see, I told you inflation was transitory, it's back to 1%. Yeah, because we have a recession.
Yeah, that's why it's back to right. Then they can claim they were right.
I've used the analogy that I go to the doctor and I say, doctor, I've got an infection in my leg. And he pulls out his bone saw and says, works every time. I'm like, well, that's not the way I wanted to fix it. And that's the way the Fed will fix the inflation rate, is that we'll chop your leg off and say, see, now we've fixed it. And that's the problem. That's the problem, is that, yeah, I think that as those rates go up and it bites, that inflation rate will probably come down, and we'll see how this plays out. But I'm not in the camp that we're ever going to see, at least with this amount of debt, like 4% or 5% interest rates. The debt cost, the interest cost burdens are just too much. But so that doesn't mean that, oh, we're never going to fix this problem, we have to go to 100% inflation. It does mean, though, that it only take a lower interest rate to cause that kind of economic damage to bring down inflation. And that's the camp that I'm in. Yeah, all we need to do is go to 2, and that's enough to cause a lot of pain and suffering.
So then what's their response once we get that pain and suffering, not just monetarily, but fiscally? And then how does that game end?
Well, yeah, I mean, their response when we get to that game will be what they did in 2020. They'll cut rates back down to zero. They'll talk about fiscal stimulus.
CARES Act 2.0.
Right, the CARES Act 2.0. But here's what's going to be the big difference. When you did CARES Act 1.0, you were in a period of many decades of no inflation. We decided that the inflation monster was permanently vanquished. We invented ideas like modern monetary theory to explain why inflation would never come back. So when you started to turn on the printing presses and borrow money and mail it out, people were happily buying your bonds and no one was worried about inflation. Now you have inflation spike up, falls hard because of inflation, falls hard because of recession. You say, we got to do CARES Act 2.0. Well, hold on a minute now. We're going to produce 9% inflation again. I'm now not as willing to buy up trillions of dollars worth of your debt as I was the last time, because I'm going to see a big inflationary spurt. It's not going to be as easy to do CARES Act 2.0 the next time around. Why were we able to do it the first time? Because everybody was willing to buy 50 basis point 10-year notes because they thought that they were going to go negative, which means that the price was going to go up a lot more, or the yield was going to go negative. They never thought that this was going to produce the highest inflation rate in 40 years. But now that they know it can, I don't think they're going to be as willing. So it's going to be much, much harder to get that stimulus the next go around. Point I'm trying to say is inflation is such a huge game changer. And people are unwilling to believe that it is a game changer, or willing to dismiss it as being transitory at some point. And so that is the problem with it. Now that I've said that, you could very well produce deflation, because I think what you need in order to have deflation later on, say a couple of years down the road, is inflation first. Because if you never have inflation, you can print your way out of deflation every single time, because you'll have willing buyers to take down your bonds.
Got it.
But once you have inflation, those willing buyers are going to go, I don't know if I want to buy those bonds, because then they'll be negative 6% real and I'll wind up losing on them. And then you never get the stimulus that you quite want or need. And then you produce the deflation. Because why could we never produce inflation from 2008 on? Because we could print almost an unlimited amount of money in order to stave it off. And no one was willing to push back on it because no one was worried about inflation.
And your argument
now
is
that we've got it, it's changed. What's that?
That's your argument for why the Fed would not step in and buy enough bonds to keep those interest rates low?
No, well, the Fed could step in. Let me remind everybody, the majority of bonds are still owned by the private sector.
Yeah.
And ultimately, I've used this metaphor that the Fed is like a post in the ground and the market is a horse tethered to that post. And as long as that horse is docile, it just stands there and it does whatever the post wants it to do. But when the horse gets spooked, it'll rip the post right out of the ground and go wherever it wants. So as long as the market is not worried about inflation, the Fed could print an unlimited amount of money and buy bonds. But when the market is worried about inflation and you start printing to buy bonds, it'll rip it right to shreds, is what it'll do. It'll be just like if you tried to print your way out of the 70s, how that would have responded. Because now that it's happened, inflation, we can't unhappen it. And we're going to be afraid it will happen again the next time that the Fed wants to start really buying bonds in a big way. And that's what I mean by that the psychology has changed, that everything has changed because of this inflation thing. And yes, this is a necessary ingredient to produce a deflation. Because once you get deflation, people will say, well, we got to print money like crazy to get out of deflation. Well, no one's going to want to buy your bonds because they're afraid that the minute you start printing, you're going to spike inflation back up. And then you get caught in that vicious circle. Well, we need to print, but we don't print because nobody wants to buy it. And the inflation rate keeps going lower and lower and lower and lower. And so that's a real possibility about deflation. But without it, I don't know how we could have deflation now. I mean, that's how we got out of 2020, because we just printed our way out because no one was worried about inflation. I hope that makes sense.
Yeah, no. So one thing I want to mention to illustrate your point is, in fact, I was looking at a chart today of quantitative easing going back to 2008 and the 10-year yield. And it's the exact opposite of what most people would expect. They think that when the Fed comes in and buys the bonds, that would lower the interest rates on the 10-year. But what you saw every single time, including this last round of quantitative easing, when they announce it and when they implement it, the 10-year rates actually go up, not down. And to your point, it's most likely because of inflation expectations. So that would put the Fed into that corner where if they wanted to come in and, let's say, monetize the debt to bring the interest rates down to a manageable level for the economy, the marketplace, that horse, would rip that post right out, because the more quantitative easing they're trying to do to buy the bonds, the more inflation expectations, the more sellers there would be.
And there's another explanation which fits right along with your line. Quantitative easing, Bernanke told us this in 2008. What is the purpose of quantitative easing? And I like to summarize it by saying, we, the Fed, will buy bonds and keep interest rates lower than they would be otherwise, so you don't have to. So you take your money and go buy riskier things like stocks. So quantitative easing is focused on the stock market, which is why if you turn that relationship around and look at the size of the balance sheet to stock indexes, it's very highly correlated.
Right.
Is what it is. You buy stocks with all your money. Well, who's going to buy bonds? We'll buy the bonds. And they might trickle up, but they would have gone up a lot more without the Fed's purchases. Okay. QT, it's been argued, which is what you're seeing now, just the threat of QT works in reverse. When you do quantitative tightening and you start removing money from the system, it hits the risky assets the worst. The Russell 2000 down 20% year to date through yesterday, at least. The S&P down 12% year to date through yesterday, at least. Bond prices are down, but not nearly as much. So QT works in the reverse, and it will really hurt the riskiest part of the risk curve, which would be equities.
And which could bring down the 10-year yield, making the inversion more probable.
Right, exactly. Because what you'll do is people will start running their money back into bonds, because, why would people buy bonds? Because if everything hit the fan, I'd lose 3% in bonds. If everything hits the fan, I lose a third or half of my money in stocks. That's why I would buy bonds at that point. And so I think that you would see, remember, the majority of bonds are still owned by the private sector. And so if you got a private sector flow, the Fed's doing QT, I don't want to be in stocks, everybody rush in the bonds. You could see those bonds, I'm not saying going to zero, but they would go to 1.5 while the Fed's raising rates and invert the curve as well. And what QT will do is it'll hurt the stock market, just like QE helped the stock market.
There's just an incredible amount of variables and cross currents here that I think everyone needs to pay attention to and be cognizant of if they want to try to get any handle on the probabilities of XYZ outcome in the markets or the economy.
Can I make a quick comment on that? There are an incredible amount of variables, and it's very, very difficult to get a handle on this. And it's very possible that a lot of what I said would be incorrect. But I recognize that. Central bankers who actually implement this policy don't think that way. They think that they've got it figured out to the fourth decimal place, and there are no unknown variables. And there's the hubris with them. I know that this is difficult and hard. They actually think it's easy. And that's the otherwise they wouldn't do it.
And one of the hardest things about it, Jim, is that you're trying to answer political questions. Going back to 2019, macro was far easier, in my opinion, because you just had to answer economic questions. But now to get those economic answers, like I said, you've got to answer political questions. And who knows what the hell these crazy politicians are going to do, whether it's Trudeau, Biden, or Putin.
Right. I completely agree that you've got these political questions. And if I might throw an idea at you, what is the result of those political questions is it's not only Trudeau or Biden or Putin or whatever they're going to do, that shows up in cryptocurrencies. Because a big argument for why we have those markets in the first place is we're ruining the traditional markets and we're trying to create a new financial system. Now it's a work in process and it can be ugly to look at a little bit at times. And ultimately, I think that it will eventually become a very valuable thing. And I think it's on its way to being that, but that doesn't mean that it won't be a thrill ride before we get there. And it is a thrill ride right now. But I think that the very fact that we've got a multi-trillion-dollar decentralized, permissionless cryptocurrency system evolving stands as a measure or a signal that a number of people think that the current system is either going to fail or is failing, and they want to get away from it. And so, yeah, that's, if you had less politics in our financial markets and in our economics, there'd probably be no need to create a cryptocurrency system. But because of that, I mean, Satoshi, when he invented Bitcoin, said that it was part of a reaction to quantitative easing and what central banks were doing in late 08 and early 09. It was one of the reasons that he created it. That was a political response by them.
And I know I'm keeping you late here, Jim. I apologize. So
I'll go as long as you want. I love talking this stuff.
And I wasn't even going to ask you this question, but I'm curious when you think Bitcoin will stop trading as a risk asset and start trading as a non-correlated safe haven.
You're right. So just so everybody knows, it is trading like it is a levered S&P position or a levered ARK innovation.
Right. Yeah, right.
is what it's trading. Now, here's why I think that's happening. In the last year and a half, you've had wide institutional adoption of cryptocurrencies. That's a fancy word for saying a bunch of professional money managers and institutional managers, pension funds, mutual funds have started to dabble in that market.
Ross Gerber's been buying it.
Oh, well, that's the kiss of death right there. Did he buy it with the PPP money that he got? Or I'll stop picking on Ross. But the thing is what they're doing is they're buying Bitcoin or they're buying Ethereum.
Right.
And in the crypto space, they got a phrase called degen, which is short for degenerate gambler. And they're all a bunch of degens. I'm going to buy Bitcoin, and they got another phrase in that space called number go up. I'm going to buy it because I want number to go up. I'm buying it because I want the coin price to go up. Wait a minute. There's a whole decentralized financial system being constructed. There's lending facilities and borrowing facilities and trading facilities and insurance and lotteries and all of this other stuff that's going on. There's options, there's futures, there's other derivatives. You're a professional manager. Are you meandering into those spaces and playing it as a new financial system? Nope. Number go up. I just want Bitcoin to go up. And so if all they're doing is buying it, Gerber's a good example of this, right? If you buy it, what are the metrics you're deciding that you're buying it on? And what are the metrics you're deciding to sell it on? You're probably going to treat it like an alternate technology is what you're going to do. And that's why I said ARK. You're going to start looking at Bitcoin like it's a version of the ARK Innovation Fund. So it goes up and down with ARK Innovation, which is going up and down with the S&P. So that's why it's correlated. All these degens are basically thinking they're trading a new technology, and it's no different than the Goldman Sachs non-profitable index or ARK. What breaks that correlation? When they start realizing it's more than that. It is an alternate financial system. Because I've argued to them, look, there's a blockchain called the Terra system. And on there's a lending protocol and borrowing protocol called Anchor. Just to give you one of many examples. on the Anchor protocol, you can borrow in a US dollar stable coin. This is a cryptocurrency that will hold its peg 1-to-1 for the dollar and has since the day it's been created. And you can lend it out on their system and get 20% a year. Why aren't you doing that? Why aren't you taking no price risk and getting a 20% return? You're certainly not getting that in junk bonds. Sure, there's a risk. There's a risk that system might fail or that something might go awry. That's why you're getting 20%. But why aren't you learning that instead of just buying Bitcoin and watching it go up? Now, when they eventually figure that out and say, wow, maybe I should be looking at these ideas that I can get these super high interest rates on stable coins and start playing around in that space, then I think it starts to take on its own risk characteristics and it breaks its correlation from traditional markets. But that's probably not tomorrow. And for right now, they are really stuck as kind of the volatile end of the current traditional financial market risk curve. They're ARC on leverage, or they're just a levered S&P ETF. It's unfortunate. They shouldn't be that way, but that's the reality that we live in.
Do you wait to add to your position until they decouple? Because that's what I've been telling people just personally. I'm like, you could buy it, whatever, regardless of the price. I'm just, and maybe long term, I'm bullish. I try not to focus on the price direction too much. But for me, I'm like, I'm going to wait to add to my position until I see it decouple from the NASDAQ.
I agree. And you want to know what really sets off Bitcoin maxis? And a maxi is these people that believe that Bitcoin is the perfect thing that's ever been created. Nothing else needs to be created.
Yeah, Bitcoin fixes that.
Yeah, Bitcoin fixes that. You want to know what sets them off? As I said, you do realize that until it decouples, as long as the correlation sticks around, what do you need for 70,000 on Bitcoin again, a new high? You need money printer to go burr. It's basically what you need. You need the Fed to basically just print financial markets into the stratosphere. Yeah. And then you'll get your $100,000 Bitcoin, and that blows their mind up, because it's the exact opposite reason, but that's exactly what they need. I'm sorry?
You need the Fed put for your Bitcoin to go up.
Yeah, exactly. You need the Fed put, and you need this, and you're arguing about how fast the money printer is going to go. So yes, buy it when it decouples, because once it decouples, the money printer doesn't matter anymore. Look, why is Bitcoin falling? Financial markets are falling. The S&P, the day we're talking here, the S&P is staged a stunning turnaround. It was down 2% in the morning. It finished up more than 1% on the day. Bitcoin was down 7% in the morning. It's up 6% today. Same move as the stock market. The same move, just bigger percentages. It's just a higher, it's a leveraged position on the same thing. So what you need as a Bitcoin maxi in this environment is you need to cheer on the same things that Ross Gerber is cheering on with his Tesla stock. What gets Tesla to 1,000 will get Bitcoin to 70,000.
Oh boy. I think you're going to get it on Twitter for that one, Jim.
Well, like I said, I don't like that that's the way it is. I don't want it to be that way. I'm not arguing that that's correct, but I'm trying to say these are the cards we've been dealt with this hand. Now, maybe in a future hand, we'll be dealt different cards, but let's not pretend that we don't hold these cards. I'm sitting here and I'm looking at my cards, and you've got 3 aces on the river. I'm folding, man. I'll try another hand at that point.
All right, man. I just really appreciate your time, Jim. As always, a tremendous conversation. For my viewers and listeners who want to find out more about what you do, where can they go?
Gerber Kowalski. Bianco Research, at Bianco Research, or biancoresearch.com. Or you can find me on LinkedIn at Jim Bianco.
Okay, awesome, buddy. Enjoy the rest of your day. Well, it's going to be exciting to see how this all plays out.
Thank you.